Welcome to our comprehensive guide on the top 23 stock chart patterns favored by technical analysts for over a century. Understanding these patterns can significantly enhance your trading success. In this video, we'll provide detailed explanations and visual examples of each pattern, helping you grasp their significance in stock market analysis. A stock chart pattern represents the interplay of supply and demand between buyers and sellers in the market. The pattern helps determine whether a trend will continue or reverse. Stock trends can be categorized as uptrends, downtrends, or sideways consolidation, and they are identified by drawing support and resistance lines on the price chart. Recognizing and understanding these patterns can be challenging and time-consuming. However, with the help of advanced tools like TrendSpider, which uses artificial intelligence, you can automate trendline and pattern recognition, saving you time and providing more accurate analyses for stocks, crypto, and forex trading.
Stock price trends can be classified into three types: uptrend, downtrend, and sideways consolidation. Each of the 23 patterns we'll cover falls into one of these categories. Recognizing these trend types is crucial for understanding the stock's future price movements. Chart patterns can be broadly classified into two types: continuation and reversal patterns. Continuation patterns suggest that the stock price will continue its current trend, while reversal patterns indicate a potential trend change in the opposite direction.
Trend lines are vital in stock chart analysis, and there are two main types: support lines and resistance lines. Support lines connect the stock's price lows, indicating potential price decreases when there's a breakdown below the line.
On the other hand, resistance lines connect the price highs, suggesting potential price increases when there's a breakout above the line. Continuation patterns occur during a stock's ongoing trend and represent periods of consolidation or rest before the price resumes its direction. These patterns signal the stock's intent to continue the current trend. Examples include triangles, flags, and rectangles.
The bull flag looks like a flag and appears when the stock price moves up quickly, then consolidates in a narrow range before continuing the uptrend. Only one bull flag pattern has a success rate of 85%, while the rest have a failure rate of 55%. The high tight bull flag is the only flag pattern you should trade.
Next up is the ascending triangle. It is a bullish pattern with higher lows and a flat top, indicating an uptrend continuation. When trading this particular chart pattern, traders will look for the breakout above the resistance level. This is typically met with increased buying pressure and is the time to buy.
Number 3 is the descending triangle. It is a powerful technical analysis pattern with a predictive accuracy of 87%. The pattern is flexible and can break out up or down, and is a continuation or a reversal pattern. It can be bullish or bearish, depending on the breakout direction. The rectangle is a continuation pattern with two horizontal parallel lines acting as support and resistance levels. The price should normally break out in the same direction as the previous trend. The rectangle pattern has an 85% success rate in bull markets and an average profit potential of plus 50%. The rectangle pattern is popular because it is reliable, occurs frequently, and generates a good win probability. The falling wedge is a bullish pattern with higher highs and lower lows that tightens as the trend progresses. A falling wedge is a technical analysis pattern with a predictive accuracy of 74%.
Another pattern is the head and shoulders pattern. It is a predictive pattern signaling potential trend reversals. Since it involves two highs, followed by a low, then another high, it can be used to predict an impending reversal of an uptrend.
The cup and handle is an accurate pattern with a 95% success rate, indicating a long slow decision point. To spot it, observe a cup shape in the assets chart formed when there is an upward price rise and then a slow decline over at least 30 trading days. The next thing to spot is two decreasing trend lines which make the handle. The handle must be less steep than the cup and last at least 5 days. Next up is the megaphone. It is a volatile pattern with higher highs and lower lows forming a megaphone shape. As prices move up and down along these lines, the volatility increases until it reaches its peak at the end of the pattern. This typically signals that a reversal may soon be underway as buyers become exhausted from the frenzy created by this volatile chart pattern. The rising wedge is a pattern indicating a potential downward trend after a period of uptrend. This forms a wedge shape on the chart and indicates that buyers are losing steam and momentum is waning. Eventually, the price breaks through the support line and begins to decline in a downward trend. This can be seen as an indication of bearish sentiment in the market. The reversal pattern accuracy shows a comparison of accuracy for different reversal patterns. As seen in this image, it shows us the most common reversal patterns and their relative probability of accuracy.
The gap pattern is an explanation of various gaps and their patterns and their significance. A gap occurs when the price of a stock during a given period is significantly higher or lower than the price range of that stock for the previous period. A gap up in the stock price is a show of strength. This tells us that the demand for the stock was so strong on the open that it jumped many points higher. The opposite is true for a gap down.
The breakaway gap usually occurs when a stock moves normally through a price range or channel, then the demand for the stock explodes, and the stock gaps out of the current trend. This is a sign of strength and a very bullish sign with a gap up. A breakaway gap to the downside is a sure sign of weakness. The continuation gap is another sign of strength, showing that demand is still strong and the trend will continue. This often confirms the initial breakaway gap. The opposite is true and a sign of weakness if the gap continues down.
Exhaustion gaps are usually the final type of gap in a trend, be it up or down. They occur at the end of a move and indicate that there is no more demand for the stock, as buyers and sellers have reached an agreement and the trend is coming to an end. If the gap is up, it's a sign of strength, while a gap down indicates weakness.
The island gap occurs when demand is so high that price and the market participants drive the price up to unacceptable levels, and the demand dries up rapidly. This sudden oversupply causes the stock to plummet as all demand is satiated. Of course, too much supply with no demand causes falling prices.
Used widely in Japan and gaining a strong foothold in the rest of the world, the Japanese candlestick chart gives an excellent insight into current and future price movements. Candlesticks give an excellent view of the open, high, low, and close of the price, pictorially illuminating and easy to see trends. They connect psychology with price patterns. The hammer can be either filled or hollow. The Japanese say the price is hammering out a bottom. What is important here is that at the end of a down move, the buyers and sellers test out an extreme low. However, by the closing bell, the price has returned higher.
The inverted hammer shows that the stock gaps are significantly down at the end of a downward move. There is much movement throughout the day, moving back to fill the gap, but the price settles lower for the day. This shows significant price action, and buyers show a strong interest in the stock at these levels. Here we have a negative spinning top or a short day during a downtrend, followed by a long day of real power. The long white body tells you something significant has changed, and so has the sentiment, a clear trend reversal. We experience a very negative, long day, followed by a short positive day during a downtrend. This indicates the market participants have found a level they are happy with. Candlesticks are most useful when predicting a change in trend. This might be from an up to a down trend or from a down trend to a sideways trend. In the case of this harami, the change in trend may be from downwards to sideways.
This shows a day of real strength following a very negative day. The white candle gaps down on open, but the buyers show real demand throughout the day to retrace more than 50% of the previous day's losses.
The pennant stock chart pattern shows that the stock price meets resistance during an uptrend, and the uptrend temporarily halts. Here you see lower highs but also a horizontal support line. This indicates that the sellers are unwilling to sell for less than this price, which builds momentum for a breakout through the support line onto new highs for the stock price. Understanding chart patterns and supply and demand dynamics is critical for successful trading. Our guide has covered each of the 23 top stock chart patterns, but implementing them effectively requires practice and learning from real-world scenarios. We offer comprehensive training to help you apply these principles to your trading journey. We hope this extensive guide has equipped you with valuable insights into stock chart patterns. Remember, the stock market can be unpredictable, and no pattern guarantees success. Make informed decisions, conduct thorough analysis, and keep learning to enhance your trading skills. Happy trading and good luck on your journey to becoming a successful trader. Free and pro investing courses, strategies and original research at LiberatedStockTrader.com.